Okay, hello everybody. Welcome to Crane Atlanta Mentorship. So we're just going to do another velocity banking review for today, but this time focused on doctors. And to start off, I actually asked ChatGPT this, and it says, I asked you like, you know those commercials where they tell you to donate your money to poor children in poor countries? Can you create a parody of that, but for broke doctors? And it's pretty hilarious, or at least for me it is. It's kind of sad because it doesn't almost feel like a parody. Like it doesn't because it's actually real life, but it's it is.
Soft, emotional piano music plays. The screen shows a tired doctor in scrubs, sitting under harsh hospital lighting, staring blankly at a student loan statement. This is Dr. Jessica. After 12 years of schooling and countless sleepless nights, she finally became a doctor, only to realize her reward was a $300,000 mountain of debt. Cut to Jessica eating instant ramen in the break room while a nurse takes a donut meant for Doctor Appreciation Week. Despite working 80 hours a week, Jessica still can't afford guacamole at Chipotle or a vacation that doesn't involve staying at her parents' house. Her dream of saving lives has been reduced to saving just enough to pay interest on her student loans. Close up on a sad latte with Dar Jessica spelled wrong on the cup.
She say sober.
But you can help. For just $19.99 a month, less than the cost of a copay, you can sponsor a struggling doctor like Jessica. Cue upbeat music as Jessica receives a tiny envelope in the mail. She opens it and smiles tearfully. Inside is a $20 bill and a handwritten note. You deserve extra gack. Voiceover. Your generous donation will go toward essentials like meal prep kits, compression socks, and maybe even a subscription to a streaming service so she can pretend to have a life outside the hospital. Montage of happy doctors, high-fiving, holding up loan payoff notices, and eating avocado toast. Voiceover. Call now, and we'll send you a picture of the doctor you're supporting, along with quarterly updates on how much closer they are to affording their own home, or at least a reliable used car. Text on screen. Donate now. Save a doctor today. Call 1-800-SAVE-MD. Final shot, Dr. Jessica smiles bravely, holding a sign that reads, "Thank you for believing in me." Because when you save a doctor, you're saving more than a life. You're saving gawk money. Fade to
Wow,
black.
that is so good. So, Dr. Jessica, if you learn the strategy called velocity banking, I 99.999% guarantee you'll be able to afford the guac at Chipotle. It's been a long time since I had the guac and Chipotle, but hey, if you're a doctor, 12 years of school, you should at least be able to afford that, right? And I asked actually ChatGPT, the very first question was, do doctors struggle paying back med school loans? And said yes. So that's where I kind of thought about, man, we should create one of those like sad piano commercials where it's like donate a monthly subscription so that you can help a poor child in some country you've never heard of, right? But we gotta do this with our own people, and I know this is kind of weird, and I always thought like, and this is just kind of random tangent before I get started, how we're so obsessed with focusing people whose names we don't know, but with our neighbors and our friends and family and people like Dr. Jessica, like we don't really help them, and we that's kind of what I is kind of I kind of have a hard time like understanding why that is, right? And I think there's that phrase where it's like think globally but act locally, and that's what we got to do with our people. So I'm going to start today with this video helping out all the doctors in the world like Dr. Jessica so that we can eventually do afford to eat at Chipotle with the guacamole, right? Man, ChatGPT is hilarious, dude. Like it's so good. It's doing comedy better than most comedians today, right? So let's go ahead and get started, and we're going to assume that we have a $350,000 income, right? $350,000. Maybe we got into a specialty and we have a $300,000 student loan, okay? A $500,000 mortgage, a $50,000 all loan, because we're a doctor, right? We got to get that $50,000 car. Maybe it's like a Mercedes or a BMW. Definitely not a truck because that's going to be $90,000. And we also have 10 credit cards. So let me just start from the beginning. We're going to do something called velocity banking. So what is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account. So anybody can use this as long as you have some debt. And so if you're a doctor, you're actually a prime target for banks, right? Because banks like to lend to people who have money. And they'll keep lending to you until you're at the point where you do need money, right? It's ironic because we think, oh, if I need money, I need to go to a bank. That's not how banks work. Banks lend money to people who don't need it. So when you're a doctor, there's probably a certain point in your life before you tackle out all that debt, you don't need money, and then you get a few credit cards, you get an auto loan, you get, well, this student loan is probably then for the rest of your life. Well, it feels like it. Um, and then we got a $500,000 mortgage. And so let's see what we can do because we only got $2,000 left over in our savings. And if we're making 17 grand a year, because I'm not grand a year, 17 grand a month, and we make $350,000 a year, um, it's going to be like, how do I only have $2,000 in savings, right? So a lot of people struggle with that and they might have a lot of debt. And what we're going to do is get rid of our debt, right? A lot of people, especially doctors, they're worried about this huge med school loan that they think they're going to have to pay 10, 20 years. And actually, let me scroll up and see if it says somewhere here how long. Yeah, it says despite these challenges, most doctors eventually pay off their loans, so it may take 10 to 20 years. So if the standard is 10 to 20 years, let's see how long it takes for us to pay off our loan using velocity banking when we focus on paying off that med school debt. Okay, so now let's go ahead and do this. We're going to do the velocity banking side of this budget. So when we do velocity banking, there's always two things that we need to do. Number one is a budget because our budget is our debt attack plan. And then number two, we need a line of credit as our main operating account. So let's go ahead and finish this side of the budget. Now, here's the thing that we're going to have to do that society is like, whoa, like, what are you doing there? Which is not have any savings. So we're gonna have something called cash flow, but we're not gonna have savings. And when we start this strategy, we're gonna try to increase our cash flow. Okay. So if we go in here, oopsie, here, this is what someone who's doing velocity banking, what their checking account might look like, or their savings account, right? You start off at zero, you get paid, and then you end at zero because we're not going to save money. What we're going to do is put all of our money into debt, into a line of credit, and that line of credit will essentially act as everything: our new savings account, our new checking account, our new quote operating account, main operating account. That's what we're going to call it. And here's the thing: let's assume that we have access to a $150,000 home equity line of credit. $150,000, right? And right now we have $500,000, at least $500,000 on the loan in the house. Maybe we bought at the right time. It's 3%. So it's a few years ago, right? Because mortgage rates aren't like 7 and 8% now, or 6. I don't know. My home mortgage is actually like 2.8, right? And then I paid it off quickly. Even when you paid at that low rate, you still want to pay it off quickly. Okay. So, but let's assume we have something called home equity. And what's home equity? All it is your home's value minus the debt on that home, right? So if you have, $200,000 of equity, banks will usually lend you 80% of that equity in the form of what we call like a credit card like financial instrument, which is a line of credit. So what's a line of credit? All it is a financial instrument where you can borrow money, pay it back, and then use it over and over again. So credit card kind of really fits in that category. It is a type of line of credit, but we're going to use a home equity line of credit up to $150,000. And I do have my own home equity line of credit for 280. Bam, right? I swipe up on my phone. I got $280,000 available for me to use and then just put into my checking account and then pay it back once I'm done using it, right? Who wouldn't love easy access to capital, right? So let's go ahead and do this. And we're going to, all right, um, uh, optimize our cash flow by moving some of our debt, right? And the most, here's the thing: a lot of people are like, well, I'm in a struggling situation now and I need a line of credit. I've only known one person able to get a line of credit. Um, but like, I'm not interested in teaching that way because I want you to have a foundation when you're broke, right? So I know one person who did, but as a general rule, you have to understand that banks don't lend money to people who need it, right? So you have to get this credit or this line of credit before you ever need it. And most people, they get lucky because they get like a home equity line of credit and then they use it wrong because they treat it like another credit card and just max it out, right? So that's not what we're going to do. We're going to use it as our main operating account. And let's go ahead and move some debt here. So let's say we have some credit cards, right? So $2,000, like, oh my goodness, we're struggling. And if we sum this all up, right, this is $142,000 of credit card debt, although this total is probably wrong. Actually, let me just do this. 142 plus 50 plus 300 plus 500. So that's $992,000 of debt. And so it's almost $1 million. So it could be daunting, to be a lawyer. I'm not a lawyer, a doctor, and making all this good money, and you went to all the years of med school, residency. Um, Now you're, I don't know, what's a $350,000 a year specialty? Anesthesiologist, right? And it's like, well, I'm broke, right? So just because you're a doctor doesn't mean anything. Plenty of broke people who make good money. And as I said, you're a prime target for the banks. Here's the thing: banks don't want to deal with people who don't make money. That's like, you don't make any money, like automatic denial, right? And you ever notice that like your credit report doesn't contain your income? It's just about how much, um, if you've been making payments on time, right? So they have a separate section for income, and then they check your credit report. But you need the income. A lot of people are like, well, if I have an 800 credit score, that's a good thing. It's like, well, do you have the income, right? So it's like you need a combination of both. But a lot of people don't understand the income is more important than the credit report, even though the credit report is important. Like you kind of have slightly bad credit and really good income, and I'm pretty sure if you talk to most lenders, they'll be like, yeah, we'll work with you, rather than like, oh, 850 credit score and no income's like, why would we lend to you? You're not going to pay us back, right? So we have to be aware of that. All right, so let's go ahead and move these 10 credit cards into the line of credit. It's $142,000. So it's kind of like a balance transfer we do. And guess what happens? Oh my goodness. These all go to zero when we do that transfer. So we went from $2,200 to 6,705. Oh, wow. Like, isn't that impressive? Like, now we feel like a little bit better. And we're just going to do this with the line of credit, and we're not going to save money. We're going to do the exact opposite of what most people are trained to do. Okay. So now let's go ahead and do this and take the next month's balance, which is the previous month's balance, previous month's interest, minus our cash flow, 6705.3. So you want to know where I got this number? It's right here, 6705.3. And then what we're going to do is take the interest, right? The interest, and we're going to take the average daily balance, right? Average daily balance, that's how they calculate the interest on a line of credit. We can use it, the average function, to estimate it, and then multiply it by 0.08, right? That's the annual interest rate, and they divide by 12, okay? Divide by 12 because it's calculated monthly, but they always give you the APR. A stands for annual, so just remember those formulas. And you might be like, you're going so fast. I'm like, yeah, but today I feel like going a little bit fast, a little bit dangerous, because I do a lot of these videos, and I don't want to get too stuck into formulas, but I thought you could just pause it. All the videos are formulas are always the same, right? So okay, now we see that in 23 months we paid off, ooh, less than 2 years. Sweet. So 23 months, 142K of debt. That was pretty easy. Less than 2 years gone. And now, okay, so um, let's go ahead and do this and highlight this here. So now what we have is the auto loan. And after 23 months, what's the balance of the auto loan? Well, let's go to the loan calculator, right? So we got this loan calculator right here. Oh, did I do 50% interest? My bad. My bad. Wow, I screwed up, didn't I? What is it? 50,000 at 7%. My bad. So it's 990. I screwed up. This is so the oh man, I totally screwed up. Okay. So let me just do this here. 990. Okay, not what was I thinking? I must have been like high or something. Okay. So let's go ahead and do this, and let me redo this again. So our cash flow is actually 7,995. 7,995. And I actually don't do drugs, so when I joke about being high, that's really a joke, or at least a bad one on my part. All right, so let's go ahead and do this. Oh, look at that. 19 months to pay off that debt. That was easy. Oh my goodness. So 19 months to pay off. See, when you screw up, you could just easily go and update your spreadsheet. You see how much easier it is when you screw up and you use the spreadsheet and just update your numbers. At 19 months, we paid off $142,000 of debt. Bam, gone, right? That's easy. People like scoot credit cards. It's like, oh my goodness, like I can't. What? You're panicking, and it's like, oh, wiped it out in 19 months. Okay, so now we go to the auto loan here, and after 19 months, let's check out what the current loan balance is. So 19, 19, 19, right? And then we see right here, current balance is 36,000. Now, look at this thing called the cash flow index. So what does it mean? It means that if we pay off this 36 grand, we get 990 back in cash flow. And the lower the number, the more bang for our buck we get for paying off that loan. That's essentially what that means. So this 229 here, what does it mean? Would you pay 483,000 to get $2,000 of cash flow back? That makes no sense, right? Because this one here, or even this one, if you look at the ratio, is you can pay $264,000 to get more cash flow back than paying off the mortgage, right? Like literally double your mortgage, or more, almost more than double, I think. Yeah, about 240, and you get less cash flow. So if you don't know what the cash flow index is, look it up on Google. But all I'm saying is that I use this as an indicator to rank all my debts to figure out which ones to focus first. And I'm going to focus on the one with the lowest number. So let's go ahead and move this auto loan into that line of credit. I'm going to move it here. Control V. So what's the value? It is, oh no, it's working on it. Uh-oh. It's thinking. It's like the Dreamcast commercial. All right, so now let's go ahead and move this. Is it 36010? Yeah, it is. Oh, sweet. Okay. All right, so let's go ahead and move this to the line of credit. 36010.010.31. Okay. And I don't know what's going on, but this is like going slow. Let me reload it. Or is my internet slow? Ugh. It's the disadvantage of using the web's version of Excel. Give me one moment to pause this. Okay, there we go. I think it's working now. So let's go ahead and do this. So because we moved this auto loan into the line of credit, we get the $990 of cash flow back. So this is now 0. Oh no, is it? Look at this. This takes forever. I can't believe it. Oh, let me pause this again. All right, there we go. I think I got everything working now. So technical difficulty. So let's see if we got it working. So what's our new cash flow? Almost $9,000. Oh my goodness. Oh my goodness. Right. And then now let's go ahead and redo this new cash flow, which is 8985.54. Right. So that's our new cash flow. Whoa! Take a look at that. So 1, 2, 3, 4, 4 months, that loan is completely paid off, right? And so now, okay, so it's 19, so 23 months, we paid off 192K. So simple. All right, so now if we go to the loan calculator right here, and then we just type in 23 months for the student loan and the mortgage, right? And this is 0. We see that we still have a significant amount of debt to pay off. And this may seem daunting, right? Seeing this $256,000 of debt. Now, if we, as I said before, when we look at these cash flow indexes, you typically tend to want to focus on the lower one, the lower number. And what we can do is we can just attack this loan into like $20,000 pieces, right? Just use an amount that's kind of like similar to your paycheck. So we could use like 18 grand, 20 grand, and then we just move it into a line of credit. We call that chunking. And we have a $150,000 line of credit. There's no need for us to actually move $150,000 if you know like how this whole chunking thing works. But we're just splitting it up into pieces, okay? So let's just do this. I'm going to move 20 grand into the line of credit. 20 grand. How long does it take for me to pay that 20 grand off? Okay. 1, 2, 3, 3 months to pay off 20 grand. So is that crazy? And actually, let me just do a quick comparison. We paid off in 23 months for our student loan, it's 300 minus 256, 44K of debt. So let me just move 44K of debt into that line of credit, and I'll just do 44 instead of 20,000. Now, here's a kind of a myth that people don't understand. The bigger the chunk, it's actually not good when it comes to like high cash flow index loans, if that makes sense. So I wouldn't actually do 44,000 in real life, but I just want to do a quick comparison to see how long it takes us to pay off 44,000 into a line of credit. So 1, 2, 3, 4. Okay. So 1, 2, 3, 4, 5, 6, 7. So 7 months. Okay, 7 months to pay off 44K. Right? So if we multiply that by about 3, we see that 44 times 3, which is, what is that number? 44 times 3. 132K could have been paid off in about 7 months, right? So we just kind of use that same principle. What makes it really hard to kind of calculate or estimate is that we're still making the monthly payment as we're doing this, and we don't need to do huge chunks. But let me go ahead and open up the Velocity Banking Calculator. All right, well, we got the Velocity Banking Calculator up and running. And then take a look at this, right? So if we just chunk, let's say $20,000, right? We pay about, takes us 1.9 years to pay it off. 1.9 years, okay? So, we only pay about 16 grand. Now, here's the thing also, the higher the chunk, the more interest that you're paying. So if I do like $40,000 chunks, it goes to literally a couple $100 more. But that's because you're moving a low interest debt into a higher interest debt. And I'll probably get into more like videos in or future videos about how to deal with that, right? It's usually just chunking method, okay? Or splitting it up into pieces, because that's usually resistant to the interest rate. Now, if we happen to have like a line of credit that's like at a much lower interest rate, say like promotion introductory rates, and we have a higher interest rate loan and we're able to pay it off during that introductory period, I definitely, in my opinion, would move that loan into a line of credit. But in general, I would not do that. I would just use this if the interest rates are higher. Okay, so let me just do this. So it's 20,000. So about 16 grand of interest, and then 1.9 years we pay off. So we just fill it in, and I'll just go in here and then type in. So what's 1.9 years? So 23 divided by 12 plus. No, wait a second. Hold on. 23 plus 1.9 times 12. So that's 48. I'll say 46 months. Okay. So 46 months, and then that'll be 492K. And then guess what? We just do the same thing with the mortgage. So down, we just type in 46 months here. We just chop the loan into pieces, and then I just type in the mortgage details, and then it'll be 500,000, 500,000. This is going to be a 30-year loan at 3%. Okay, what's the current balance? 458,227.31. So 458,227.31. 458,227.31, right? 458,227.31. And what is our monthly payment? Our monthly payment is 2108.02. So 2108.02. And then what is our cash flow now is $3,000, because we've taken everything into account except for the loan we're trying to pay off. And now 2.8 years. Wow, that was easy. Okay, that was easy. 2.8 years. Dang, that was way too easy. Gosh, like when I take a look at this and look at all the possibilities if you're a broke doctor, that's crazy, man. So it's 46 divided by 12 plus 2.8. So that's 6.63 years debt free. I'm so jealous. Like, look at this. 6.63, like 2.8 years mortgage free, and now you're completely covered in cash flow, and now you could raise your budget for expenses, right? So, dang. Like now Dr. Jessica, now you can afford the guacamole, right? See how that easy that was? And just as a quick plug, If you want to know where I got this calculator from, I learned it from Renatus. I originally learned velocity banking from Renatus, and just kind of full disclosure, I actually sell their products as an independent contracted marketer. So if you're interested in learning not only about velocity banking, but about financial literacy, um, go ahead and click the Google form link below. All right, so that's kind of my quick plug. All right, so here's the thing, right? Now it's time to celebrate with some guac. Guacamole for Dr. Jess, right? No more of that sad violin music for our poor little doctors, okay? All right. All right, cool. All right, well, that's it for today. Happy Friday. It's almost December. Beautiful day. Have a great day, everybody. And this is Korean Atlanta Mentorship, and we will speak next time.